Just when you thought the reopening trade in China is fading, you get a huge data that supports buying China.
Well, I think, we have to understand that China was closed for such a long time that it's probably unrealistic to expect the reopening trade to only last for about a month. I think what we do need to see, though, is how long the data continues to stay strong. Clearly, we're going to get a boost for GDP in the first half of the year. The real question is what happens into the back half of the year, into 2024.
So what assumptions are you making and how are you playing China?
Look, I think we are always fundamentally a bottoms-up shop, right? So we look at the individual equities. But I think the fundamental assumption we're making is that generally policies will be accommodative and, pro-growth. We're not sure that we'll get big bang announcements out of the NPC this weekend, purely because, as your colleague mentioned, you have a lot of new faces at the helm. But I think what we are looking at is that there's probably pent-up consumption demand with savings that needs to be spent. And those are the areas of the economy, small, medium enterprises, consumption, et cetera, food, clothing. That's probably going to be something that'll see a stronger, more sustained bounce back, other than, let's say, large ticket items where consumers are probably still a little bit cautious given what they're seeing on the global environment.
Rahul, looking ahead to the weekend as well, many people were looking for that to provide possibly a catalyst for markets. Well, we got that already, you could argue. But what kind of policy support measures are you expecting from that Congress?
Well, I think the first thing we always look for is consistency, right? And with President Xi, we've always talked about trying to upgrade China's industrial experience, whether it's focusing on new areas of the economy, electric vehicles, energy efficiency, things like that. So I wouldn't be surprised if there's a reoccurrence or reiteration of the focus on those areas. Also, I think, trying to focus on stimulating consumption to be part of the China demand story, as opposed to purely going down the infrastructure and capital-intensive route of the past. I suspect those are areas that, will get more of a focus. Again, that being said, we have lots of new faces, and, China's policy tends to have a way of surprising people, as we've seen in the past.
So, Rahul, which are the industry groups which benefit the most? And, many people said it's the ones which were left behind the most last year, which made the ones that win. But I had a guest on, for instance, just day before yesterday, was suggesting that looking, let's say, tech and looking at some of those big tech names, he regards them as being essentially utilities now. What's your take?
Well, I think when you look at large tech, what you have to see is while regulation, in terms of new regulation, may have run its course, I think there generally is an environment where it seems like policymakers are trying to stimulate competition below the hood. So, I would tend to agree to some extent that perhaps the areas of tech that would get more focus and would be more exciting are not necessarily the big, the media and internet names, because those are really in the eyes of the regulator. And if the regulator is trying to promote competition, then, big media, big internet tech, while they'll probably do all right, given that incremental regulation is probably not going to be intensely negative, you probably want to be looking in other areas.
In the broader market, Raoul, it's still about inflation and what the Fed does. Now the market's pricing in fully a 25 basis point hike for each of the next 3 meetings, and some say the probability of a 50 move in March is now at 30%. What are you pricing in, and where will markets go from here? How much more upside, or are we looking at a downward slope?
Look, every fund manager will have their own assumptions right now. Our economists in the US do think that there's some risk if we continue to see that the disinflation impulse slows down, as we saw in January, that yes, hiking impulse for the next few meetings might actually continue into July. And in that case, I think the market's pricing in close to 5.4, 5.5% in terms of terminal rate. There's a non-trivial possibility that it could be slightly higher than that, whether it's 5.5, 5.75. I think where we're coming from is, we've been relatively concerned for some time that rates, even if they don't go much higher in terms of hikes, will probably stay higher for longer. And as a result, the impact of how that feeds into both company earnings from consumer behavior on top line, as well as financing costs in other areas, may not be completely in the market. So really, we would be fairly cautious in terms of trying to understand the implications of higher and longer rates on the equity markets at this point.